Hey everyone, happy Thursday, November 30th. It's about 10 a.m. on the West Coast, and it's time for another market update. I hope everybody had a great Thanksgiving last week. Where we left off, markets have been rallying pretty good. Gave some back on Wednesday and Friday, but this week's gone pretty good. So a lot to cover, so let's get right into it. First thing we got was October's PCE inflation data. This is the Fed's favorite form of inflation, and it came in as expected. The headline was, flat month over month, and the core went up 0.2, but that's replacing last year's number, so it kind of brought things down a little bit. So let's take a closer look. Like I said, headline flat, core up 0.2. So the headline's down to 3% year over year, where the peak in 2022 was 7.1%. And now the core is down to 3.5% from a 5.6% peak. And keep in mind, the Fed, what they keep saying, Jerome Powell down here, we have the the quote, they're strongly committed to bringing core inflation, which takes out energy and food prices, down to 2%. And one thing, if you take a look, if we annualized the core inflation over just the 6-month period, not a full year, this 3.5 number, but a 6 month where kind of it's trending, that's 2.4%. So that's a really good sign. So that's something to keep in mind. Next thing we got was September appreciation. So the FHFA and Case-Shiller. Both of these are the, the Case-Shiller is the gold standard, the one, everybody kind of looks at. And the September FHFA basically takes out, jumbo and cash deals. So, loans above the conforming limits and cash deals. So that tends to be, lower price homes. So let's take a little closer look at these appreciation numbers. So now we got this whole chart filled out from January to September. And as you can see, Case-Shiller was up 0.7% in September. FHFA was up 0.6%. Year over year, Case-Shiller is 3.9, FHFA 6.1. Both are at 6 and 7% 2023 pace. We could probably expect these numbers to come down a little bit over the last quarter, because right here we're at September. We still got October, November, December, and seasonally those tend to slow down a little bit. So we'll see these come down. But again, current homeowners are in a good position across the country, a lot better than people expected heading into the year. Next thing we got was October new home sales. So new builds, that was down month over month 5.6%, up still year over year 17%. They've really been filling the void with not a lot of inventory out there on the existing side. Median home sale, one thing I want to point out, the median home sales came down 3.1%, and a lot of the housing news was making a big deal about this as, kind of run for the hills. But one thing to keep in mind, that's based on the mix. The median is based on the mix of sales. So as you can see, based on this chart, back in August or so, they started, the homes they started selling were all, started to be less of these over 500K and more of these, 200 to 500K. So builders are basically building more lower price homes, and that's bringing that median down. So it's not necessarily, homes are getting cheaper. It just means they're building cheaper homes, more cheaper homes. Next thing we got was October pending home sales. And keep in mind with these October numbers for home sales, this is also when rates were got above 8%. So kind of the worst. We've come down off of that. So that's obviously getting affected too. So we can kind of assume November numbers might be a little bit better. And the October pending sales down 1.5% month over month, down 8.5% if you can see that year over year. Basically, we just need more housing out there. We need more inventory with, just like existing home sales. Pending these are, existing homes, not new builds that are in contract right now, but haven't closed. And as you can see, this index they use, we're above 100, basically, going expanding, and under 100 is contraction. You see, 71.4, it's dropped off in 2021, 115. So again, just need more inventory, as Dr. Lawrence Yoon here, the NAR chief economist, states in his little quote. Next thing we got was initial job claims. That came out today, 218,000, basically in line with the estimates, depending on what estimate you were looking at. One thing to point out, continuing claims were up now to, I think, 1.927 million, which is the highest level for over 2 years. So what that shows, again, is, people are, employers are holding on to employees as long as they can. But once people do lose their jobs, they're having to stay on unemployment longer and longer, which shows not necessarily the strongest economy. So, between this and PCE inflation coming down, that all kind of bodes well for us, because we know the Fed is paying really close to the labor market and into the inflation numbers. Next thing we got. So earlier this week, we got the second reading, the second attempt they did at the Q3 GDP for the United States. They came in at 5.2%, which was above the estimates of 5%, but it's really being buoyed by some things that's not sustainable. And the other thing, with this high of a reading, when they go to do Q4, those numbers is going to have a hard time comparing to these numbers. And so we might have a really low number for Q4 in comparison, or maybe even go negative, which again is not the greatest sign for the economy. And so hopefully the Fed's paying attention. So where does that leave us? The average 30-year conventional for good borrowers, according to this lender survey, is down to 7.15% from 7.35 last week. So again, moving in the right direction. We are above 8, getting closer back down to that 7. Wanting to keep going, keep that rally going. But and like I said, there's a lot of things that going forward are kind of working in our favor as far as inflation. Kind of like where it looks where the economy and jobs are headed. So we just got to keep our close eye on that, and hopefully we can keep this rally going. Next week, speaking of keeping the rally going, next week is Jobs Week, headlined by the BLS Jobs Report. That would be what? That would be next Friday. So the day after I talk to you guys, so we'll go over kind of what we're expecting next Thursday, but that's a big one. We're going to get the other job reports throughout the week. Again, Fed's paying really close attention to that. Those job numbers coming in our favor. Unemployment ticks up. Not as many jobs created. That could keep this rally going and really, help us out on that front. And then after that, we got CPI inflation, and then we'll get probably producer inflation, I think, the same day as this Fed meeting. So 2 weeks from now, we got that Fed meeting on the 13th, which I believe would be on the Wednesday, or not. It was when they'll do the rate hike announcement. So right now, the market's saying about 95% chance that they're going to pause. 5% chance they might hike again. But most people are expecting, obviously, based on those numbers, that they're just going to pause at this point. So, where does that leave us? Heading to the last month of the year, we're kind of heading in the right direction. Like I said, obviously things get a little slower this time of year as far as, the markets go, as far as, housing being listed and things like that. But as far as inflation goes and the job markets goes, and where, rates seem to be headed, we're heading in the right direction, which is exciting because things were pretty dark there for a second. So hang in there, everybody. If anybody has any questions at all, don't hesitate to reach out. I'd be more than happy to help. Have a great day, everybody.